Well, to be honest, I think it's been a long time coming. We've had stronger growth in the US for a number of years now. We've been seeing it coming through in Europe, and with the ending of the QE programs or the tapering, depending on which jurisdiction you're in, I think it's a recognition or an acknowledgement from the bond market that the interest rate environment we were in was inappropriate for the level of economic growth that we've got going on globally. Really, I think it's probably the complacency that they think they're in a safe asset class, when in reality an increasing rate or yield environment actually hurts traditional gilt funds, traditional investment grade bond funds. So they really need to look into their portfolios or into their investments to see how much interest rate risk they're running. Yeah, well, the simplest way really is to buy in investment grade is to buy shorter dated bonds with a shorter time to maturity, because they have less interest rate risk, or duration as we call it. Another good asset class is floating rate notes, whose coupons increase as the underlying level of interest rates in the economy increases. And clearly the ultimate low duration, low interest rate risk asset is cash, but cash does have downsides as well. The absolute level of interest you get in your bank account at the moment, if you have a lot of it and you're above the 85,000 threshold on the deposit insurance scheme, it's not risk-free. If the bank where your money goes bust, then there's a possibility that you could lose that cash. And clearly, if you think inflation is here to stay or is likely to rise, it will erode the value of your cash over time. I think the first thing that we worry about is reducing our volatility and reducing our interest rate risk, which clearly in a short-dated fund that's kind of baked in already anyway. But the other lever that we have is credit risk, and there are opportunities out there in credit, so we can harvest that credit spread. If you think about it, an improving economy, global economy, will be good for corporates. Earnings will be up. They'll have more cash on the balance sheet. They're more credit worthy. They're more likely to pay back their debts. So it should be supportive for credit spreads, and within corporate credit, we think asset-backed securities are a really interesting area at the moment.